Hello and welcome to this extra class, this bonus pack class, okay, where we are going to see how to solve the Servicom case that we say that you can try to solve by yourself, but I'm going to solve in this moment and I provide you this video in order to see the final results, okay? So we are going to go to our Excel sheet, okay? So we are going to try to complete the exercise and see the final result, okay? First of all, I'm going to remember, okay, which is the steps that we have to develop for this product. So first of all, you remember is time horizon, okay, time horizon. The second step is absorbed founded, absorbed founds, okay. The third one is generate founds. Then we go for the amortization, okay. And the fifth one is a final value, okay, final value of the absorbed fund. And the next step is cash flow of the project, okay, great. So we are going to start with the time horizon, okay. And in the time horizon, we have to read in the case, okay, that, the life of the project is in the second page, okay. Review teams is estimated at 5 years. However, in 4 years, the appearance of competitor product make it difficult to think that the product will continue to remarketed, okay. So we take this one, okay. So the time horizon for this project is going to be the year 0, okay, plus 4 years, okay, because in the third year the company say that could be difficult to continue selling this product, okay. So we're going to make 5 years, 0 plus 4 years, okay, the time horizon of this project, okay. As I mentioned, depends on the project, could be longer, okay. You mentioned that in your project is still 30, 35 years, okay. In this one, we are going to make shorter, that is only 50 years, okay. So this is the first step, time horizon of this project, okay. The second one is to fix the absorbers fault, okay? That is the CAPEX and the NOF, okay? So we are going to develop the CAPEX and the NOF. So here we say absorbed funds, okay? So we are going to start to read in the case, okay? So here we say the Equatorian energy company Equalud has decided to launch a new product that consists of creation of maintenance service for its clients, Servicom company service. This maintenance service includes a fixed fee from per year that user must pay and provides them with a visit of their facility every 6 months, free travel in case of breakdown, and 5 discount on their bill, for which they request that the final investment project must be prepared, the economical analysis is launched, and to do it provide with the following information. To carry out the reviews, some equipment is necessary. The company has a fleet of review equipment that it bought 5 years ago and it cost 30,000 euros, okay? This equipment is completely depreciated, and furthermore, if it's not used for this project, equipment will practically have no application, okay? So, as we mentioned during the class, okay, this is a shrink cost, okay? So we are going to include in the project, okay, review equipment, okay, but the value that we are going to put in this equipment, okay, is going to be 0, okay, because as we mentioned, this is a shrink cost, okay, so it's completely amortization with amortization, and it's not have to be any kind of use if we don't put in this one, okay. So we use this one, so we're going to put in that one, okay. The new service will be installed in a rent warehouse, okay, that will cost the company 50,000 euros annually, okay? As it's a rent, we are not going to use in the absorbed fund. It's going to be a general fund in negative, okay? The rest of the elements for the provision of the service are estimated is 400,000 euros, okay? So here we are going to say rest of elements, okay? It's going to be 400 euros, 400,000 euros, okay? So we put here, okay? Great. So we use this one, we are going to mark, okay? The company is going also to acquire a warehouse whose acquisition price is 350,000 euros, located in a land that is valued in 100,000, okay? So here we have the land of warehouse, okay? Okay, that is 100,000, okay? And in the second one, we have the warehouse. That is 250. That is the rest of the cost, okay? So the company is also here, okay? The company has two bonds that it will incorporate into the project for 2 years, and that is practically do not use each one. Cost when they buy is 20,000 euros, okay? And they were expected to use 10 years, okay? The expenses that the company will have to assume for stopping using bonds in their current use is 3,000 euros per year, okay? So here we have 2 points, okay? One of them is an absorbed fund, okay? That is the cost of the bonds, okay? We are going to see now, which is with the cost that we are going to use, but we are also an opportunity cost. The opportunity cost is the expenses that the company is going to have in the current unit where they are using, okay? That is the 3,000 euros per year, okay? Okay, talking about the cost of the bonds, okay, they have two bonds. When they buy the bonds, the cost is 20,000 euros, okay? But the estimation of the company is this bond is going to be in the company during 10 years, okay? But it has spent 2 years, okay? So here we have the bond, okay? We have two bonds. The cost of the bond is 20,000 euros per year, okay? And so the total, okay, is 40 euros, 40,000 euros, okay? The estimation of the company is to use these vans during 10 years, okay? 10 years. So the annual amortization, ¿vale? Or amortization, okay, is 10% per year, okay? So the amount of amortization annually, okay, amortization annually, okay, is 40 by 10%, okay? As they have spent 2 years, okay, spent 2 years, okay, so the accumulated amortization is 4,000 by 2 years, okay, is 800, 8,000, okay? So this is the value of the bonds that have depreciated during this year, okay? So the current value of these bonds, okay, is 40,000 less 8,000, okay? Now the cost of the bonds, the current value of the bonds is 32, okay? So the cost that we are going to include in our absorbed fund is this one, okay? Bonds is 32 thousand euros, okay? Because the bonds in this moment didn't have their previous, the historical value, okay? Because this is the historical value, okay? But in this moment, okay, the bonds have depreciate, have an amortization of 2 years, okay? Great. So we have used this one. Okay, we have to use in the generate funds the rest of the one. Okay, and the other part, this is the capex of the project. Okay, capex of the project. The other point that we have in this case is the NOF. Okay, but we cannot in this moment calculate the NOF because for the NOF we need the sales of the company. Okay, so we cannot use put in this moment. Okay. Okay, so with this one, we have completed the absorber found, the part we can manage. Okay, so we are going to move into the generate fund. Okay, so here we are going to calculate the generated funds. Okay, so for the beginning, okay, in this case, we know which is the total market for this kind of service. Okay, so we are going to put here, okay, market, okay, market. And the case say that in the first year is 504,000 of units, okay. In the second is 509,000 of units. So we are going to copy here 500,000 of unit, 59,000 of unit, okay. 515,000, 515,000, and the last year is 520,000, 520,000 units, okay. So we have here, which is the total of the market, okay, where the company is going to develop, okay. Then, so we are going to put here this one, okay. And here we have the market share of the company, okay. The market share objective for the company, okay. So here we have market share, okay. That is going to be for the first year 3%, okay, 3%. For the second year is 5%, 5%. For the third year is 6.5, 6.5%. And for the last year is 7.5%, 7.5%, okay. As you can see here, we have the information for the fifth year, okay, but this is a trick, okay, because as we mentioned, the time horizon of this project is only 4 years, okay. So if we multiply, okay, units, okay, is going to be market by units, okay, and we have here the units that we are going to sell along the 3 years, okay. Great. Then we have the price, okay, but this is the final price, okay. The price that include the distribution cost and the taxes, okay. So the price for the first year, for the first 2 years is 450, okay. But this is not, and the rest of the year is 500, okay. But this is not the net price for the company, okay. The company is not going to get these figures, okay. So in order to get the final price, okay, first of all, we have to take out the taxes, okay. So the price without taxes, okay, it's going to be here, say that the taxes is and the rest taking into account tax 7%, okay. So in order to calculate the price without taxes, okay, we have to divide it, the price by 1 plus 0.7%, okay. So the price without taxes, okay, is going to be 420.56, okay. And if we copy this one to the rest of the year, we have the result, okay. And in order to get the net price, okay, that is the price that the company indeed is going to have, okay, well, we have here to divide it the price without taxes by 1 plus here we have the margin channel is 5%, okay? 5%, okay? So the really net price for the company is going to be 400.53 for the first year and the second year, and 445.04, okay, for the rest of the year, okay? So the total net sales for the company, okay, is going to be the units that have to sell the company by the net price, okay, and we have here the net sales for the company for the 4 years that we are making the final estimation, okay. So we have here the information of this one. Okay, great. So now we are going to calculate, because here, okay, so we have used this one, okay. The incomes of the company for this project is not going to only to be the fee, okay. So some of the reparation is not included in this fee, okay. So here the income generated by reparation is estimated in the following percentage based on the years on the net income obtained by the company, okay. So repairs, okay, repairs, okay, say that for the first year is 20, 25, 30, 35, okay, 20%, 25%, 30%, 35%, okay. So net income by repairs, okay, it's going to be this one by this one, okay. So this is the income that we are going to receive by the incomes, okay. And finally, we have a discount, okay, that we are making in the bills of the clients, okay. The case say that the average income of each client is going to be, the average bill of this client is going to be 6,000 euros, okay. So we are going to multiply, okay, the numbers of client, okay, by 6,000 euros by 5%, okay. So this is the discount, okay, that we are going to make as average, okay. Okay, so we are going to multiply the 600, okay, by 5%, okay. That is going to be the average of the income that we are going to make, okay, by the units that we are selling and the reparation that we are making, okay. So it's 19,000 euros, okay, 1,900,000 euros, okay. So this is going to be 600, okay, okay. Okay. Well, so the total income for the company, okay, is going to be the net sales plus the net income plus, excuse me, less the discount that we are going to make for the clients, okay. So here we have the incomes that the company is going to have every year, okay. Great. So we have used this one, okay. The estimated cost for the maintained service are displacement 20 euros, labor 25, and the rest of the cost 15. Okay, so the total cost, okay, total cost, okay, is going to be 20 plus 25 plus 50. Okay, that is going to be 60 euros. Okay, so 60 euros, okay, for all the years. Okay, so the total cost, okay, this is the cost per unit, total cost per unit. Okay, so the total cost is going to be 50,000 by 60 euros. Okay, this is going to be the cost for the company to have this maintained service for all the clients. Okay, so we're going to take here, we are going to move, and we have here. Okay, so the contribution margin, okay, contribution margin, okay, is going to be the total income less the total cost, okay, the variable cost of the operation. Okay, so we are going to make some format in order to see more clear. Okay, we have this one that is the unit. Okay, here we have the price calculation. Okay, great. Here we have the sales. Okay, and this one is the total income of the company. Okay, I'm going to put this one. Okay, and we have here the contribution margin. Okay, great. Now we are going to raise the marketing communication. Okay, marketing and sales. Okay, and if we move to into the case, okay, here say that at the marketing level, the company has allocated a budget of 400 for digital action during the first 2 years. Okay, so here we have marketing, sales, okay, digital, okay, and we have for the first 2 years 400,000 euros, okay, and for every year a budget of 200,000 established for the rest of marketing, okay, rest of marketing action, okay, so is 400,000 for all the years. Okay, so we can copy this one. Okay, so this is the rest. Okay, so here we have the commercial margin. Okay, that is going to be contribution margin less digital less rest of action. Okay, so this is the commercial margin for the rest of the years. Okay, so we can put here the square. Okay, and we have here the commercial margin and the contribution margin. Okay, great. So we have used this one, so we can mark it in order to know that we have been used. Okay. Okay, great. So next step is the fixed cost. Okay. So here for fixed cost we have staff, okay, suppliers, and travel and diet. Okay. So we put here staff, or human resources, okay, that is going to be 800,000. Okay, the next one is suppliers. Okay, that suppliers, okay, that is going to be 2,000. Okay, and the third one is travels. Okay, travels, that is going to be 100,000. Okay, so we put with the format, okay, and we are going to copy the rest of here, okay. So here we have used this one, okay, but we have to take into account, okay, that we have also the warehouse that is going to rent 50,000 euros annually, okay. Okay, 50,000 euros, okay. And also we have the opportunity cost of the bonds, okay. So this one is complete, okay. And the opportunity cost that is 3,000 euros, okay. So here we have that is 300,000, okay. So we have here 3,000, okay, great. So with this information, we have EBITDA, okay, that is going to be the commercial margin less the human resources, less the supplier, less the travel, less the warehouse rent, and less the opportunity cost, okay. So this is going to be the EBITDA, okay. So we can put here this one, and we can put this one, okay, like that. So the next step is amortization. So, well, here we have the element that we have to amortize, okay? So here we have amortization, yes or no, okay? So the review equipment is no, okay, because you don't have cost, okay? The rest of the element, yes, okay? The land, no, okay? The warehouse, yes, and the van, yes, okay? Great. So here we have to put the percentage of amortization annually, okay? So in the case, okay, we have here that the amortization buildings 3%, okay? So here is the warehouse, okay, 3%. Transportation element is going to be 10%, okay? And for the equipment and maintains, okay, that is this one, 10%, okay? 20%, excuse me, 20%, okay? So the annually amortization, okay, is going to be 400,000 by 20%, okay, 250,000 by 3%, okay. And for the bands, okay, we can use different system, okay. We can set 10% of this value, okay, or as in our case, the bonds are in the company, okay, and we can use the same amortization that we are using in the previous year, in the 2 first years, okay, we can make an amortization based in the original value, okay? We can use the original value because these bonds are in the accounting of the company, okay? So we can continue, okay, using the same value that we are using from the beginning of the, when we buy the bonds, okay? So total amortization, okay, is going to be the summatory, okay, of the three elements that we have in the accounting, okay. So now we are going to put this cell, okay, with blocks, okay, because it's going to be the same for the next of the years, okay. So we can copy this one, okay, and we have here a bit, okay, that is without the depreciation and amortization, okay? So the EBITDA less the amortization, we have the EBIT, okay? So we are going to put here the format, okay? And we are going to copy this one for the rest, okay? And we are going to complete here, and we are going to put this one, okay? So the next one, okay, is going to be the taxes, okay? In the case, say, well, we have used amortization, okay? And in the case says that the tax rate is 30%, okay? So tax rate is 30%, okay? So you are going to move to multiply 40%, okay, by the profit, the EBIT of each year, okay? So we are going to copy that one, okay? And here we have the net profit, okay? Net profit. That is going to be the EBIT less the taxes, okay? As you can see here, we don't have fiscal credit, okay, because from the beginning the project is solved, okay, is positive, okay. So here in this case we don't have the fiscal credit that we have in the other case when we start losing money, okay. So we have to start to pay taxes from the beginning, okay. Okay, great. We have here the general fund, okay. Net profit is the same as generate funds, okay. Okay, great. So we have to complete now the NOF, okay. Here for the NOF, okay, we can see here, okay, that the case say the estimates average customer account, okay, accounts receivable is 30 days, okay. So 30 days is the payment, the time of payment for our clients, okay. The average stock need of the company is 608,000, okay, and the payment to suppliers will be made with 90 days, okay. So now we are going to take here, okay, and we are going to say, okay, clients. What we are going to do here down, okay, no, okay, clients, customers. Okay, so we are going to take the net sales, the net income, okay? We are going to divide by 360 days, okay? And multiply by 30 days, okay? So the account, the customer account, okay, is going to be 530,000, okay? And we are going to move this one from the rest, okay? The stock, okay, that we are going to have is 680,000, okay, for the years. 680,000, okay, for the years. Okay. And the payment for the suppliers, okay. Suppliers, okay, it's going to be the purchase of materials, okay, that is going to be the total cost, okay, plus the suppliers, okay, divided by 360 days, okay, and multiply by 90 days, okay. So it's going to be that one, okay. So in order to calculate the NOF needs of every year, okay, we save the customer plus the stock less the suppliers, okay. This is the money that we need for every year, okay. So the investment of NOF, okay, is going to be only the difference, okay. For the first year is going to be that one, okay. For the second year is going to be that one less this one that we invest in the first year, okay. For the second year is going to be that one less that one we have in the second year, and for the third year is that one less that one, okay. So this is indeed the figures that we have to include it in our project, okay? Because it's indeed the investment, not the needs that we need for and then NOF, okay? So here we have NOF, okay? okay, investment. So we are going to copy that one, okay, for every year, okay. Great. So we have finished the general funds, okay? We have complete. We have the amortization, okay? So now we are going to calculate the final value, okay? For the final value, okay, is the original value, okay, less amortization, accumulated amortization, okay? So for the in negative, okay? For the absorber review, as we don't have any value at the beginning, we have not value for the end of the period, okay? For the rest of the element, okay? As the project is for year, okay, the accumulate amortization, okay, is going to be that one, okay, by 4 years, okay? The same for the warehouse, okay, that one for 4 years, and the same for the banks, okay, for 4 years, okay? So here we have the figures for the accumulated amortization that we have to make, okay? So the final values for the rest, okay, is going to be negative, okay, the original value, less the amortization during this period, okay? It's going to be less 80,000 euros, okay? The land house, okay, as we don't have any additional information, is going to be the same one, okay? The warehouse, okay, is going to be the original value less the amortization of these 4 years, okay? And the vans, okay, is going to be the original value in this project, okay? In this project, less the amortization, okay, during the period of the project, okay? And for the van, okay, final value, okay, we can get all the investment, okay, that we have made during all this period, okay, because we can take everything, everyone, and we can sell the stock and everything, okay. So with this one, okay, we have here the let me put here this one. No, is this one, okay, and this is the total absorber funds. Wait a moment, we have here, okay, from here to here, okay, and we are going to copy all the years, okay, and now yes, we can put this one in black, and here we can make this one absorber fund we have here, okay. So time horizon is here. Great, great. Okay, so now we have also the final value, okay. So now we can calculate the cash flow, okay. As we have mentioned, the cash flow, okay, is going to be generated fund less absorbed fund plus amortization, okay. So for the first year, okay, we say generate fund 0 less absorbed fund plus amortization that is here, okay. So we have here this one, okay, and we can copy for the rest of the years, and we have the cash flow of the project for all the years, okay. Okay, great. So now with this information, okay, we can calculate I'm going to put in blue, and here I'm going to complete the cash flow that is already done, okay. The three rate that we have calculated, okay, payback, van, and tip, okay. So we are going to the case. We have used this one, okay, great. We have used this one, great, okay. And here, what we have here, this one that we have been used, okay. And we don't have more information to use, that this is all information that we are going to use, okay? So, in order to calculate the payback of the company, okay? So we take that one, okay? And we're going to use the value, okay? So here we can see that the first year the project is losing 782,000, okay? But the first year, okay, that the company start with the project, okay, we earn more than 1 million, okay? So here we cannot accumulate more than 1 year, okay, because in the first year we get more money than the initial investment, okay. So directly we can say, okay, this one, okay, divided by this one, okay, we only need 46% of the years, okay, of the year, okay. So we can say 1 year, okay, and 46. As 1 year, okay, have 12 months, okay, we need 26 by 12 months, okay, 5 months and 56, okay. So we need 5 months, okay, and the rest is 5 less 5.57 less 5, okay, of month, okay. As 1 month have 30 days, okay, we need 0.57 by 30 days, okay, 70 days, okay. So the final solution is 1 year, 5 months, and 70 days, okay. Or what is the same is 17 June 1st year, okay. So this is the payback of this investment, okay. Okay, we are going now to continue with the net present value, okay, the VAN in Spanish, okay. So we take again the cash flow, okay, and we have to calculate the K rate, okay, that we are going to use for this, okay. As we mentioned, in many companies today, they use the WACC, okay. So here in the case, okay, we can see that they talk about the inflation, okay. Now the companies didn't use the inflation, okay. The finance for this project is 12%. We don't use the finance of this project. We use the work that we can use with this element, okay. So the company owned resources are 200,000, okay. So we are going to put here, okay, net equity, okay, 200, okay, and the external finance is 1,200,000, okay. External is 1,200,000, okay, which is the cost of this equity, okay. Cost for the internal one is 32.65, that is the raw, okay, 32.65%, okay. And for the external one is 5.6%, okay, 5.6%, okay. So, well, we can calculate here, okay, we can see here, okay, this is the total, okay, and we can calculate here 200,000 by this one, and 1 million by this one, okay. And now we have to eliminate the taxes effect, okay. So here, this one without tax effect, okay. This one we have not say anything. And for this one, okay, we have to multiply, okay, by one less taxes, okay, that we have here, okay, is 30%, okay. So here is the cost of the external debt, okay, but without the effect of taxes, okay. So here we can add this one, okay, and the WACC, okay, is going to be the total cost of the debt divided by the total equity that we have, okay. So the final K, okay, that we are going to use is 8.02, okay. That is going to be the rate that we are going to use for the net present value, okay. So now we are going to calculate. This one is okay because it's in the current year, okay. And we are going to calculate the next one, okay. This one divided by 1 plus 8.02%, okay. 1 exponential, okay. The next one, okay, is going to be that one, okay, divided by 1 plus walk, okay, elevated to the square, okay. The third one is going to be that one, okay, divided by 1 plus walk, okay, and for the last year, okay, divided by 1 plus walk fourth, okay. So now we have here all the cash flow, but in the current year, okay. I'm going to include here some lines, okay. In order to see this one is that one, okay, and this one is this one, okay. This one is going to be that one, okay. This one is going to be that one, and this one is going to be that one, discounted with the walk average, okay. So net present value, okay, is going to be when we added all this one, okay. Great. And finally, okay, we are going to calculate the ERI, okay, that we call TIR, okay. So the TIR, okay, is going to be here we call the function TIR, okay, and we say that we are going to calculate the TIR of this element, okay. So we say, okay, this is the TIR of the this project, okay. So here we have the net present value, okay, and here we have the TIR, okay. In order to make the last to see if the calculation are okay, okay, we are going to substitute the WACC, okay, by the EII, okay, and the net present value have to be 0, okay. So we do that, okay, and it's okay. The net present value with this percentage is 0, okay. So we can say that the case is complete, okay. So, well, we have here all the view of the case, okay, when we can see the generated, the absorbed funds, okay, the generate fund, how we calculate, okay. In this case, we have to calculate the NOF, okay, because NOF is not so easy on the previous one, okay, and the cash flow and the three elements, the payback, the net present value, and the RI, okay, for analyze the situation, okay. So we are going to put that here, okay, this is work. So I'm going to save this file, okay, and I'm going to send you by email the file, okay, and also the this video, okay, in order to have the final result of the case, okay. Thank you very much for your attention, and as I mentioned previously, if you have any doubt, didn't to hesitate to contact me, okay. Thank you very much. See you. Bye.